Everybody thinks AMC is a dead stock, a meme that ran out of sequels, a cautionary tale you scroll past on your way to the next big trade. But what if I told you that while retail investors were panic selling and headlines were screaming about a 9% drop, some of the biggest, smartest, most ruthless financial institutions on the planet were quietly loading up? What if the exact moment everyone gave up on AMC was the exact moment the smart money started buying? Today we're breaking down whether an AMC squeeze could actually be incoming, why the so-called smart money is stacking shares in silence, and the one date next week that could change everything. It's July 10th, and this stock is a violent battleground between two completely different realities. By the end of this video, you'll understand which side is about to win. If you're the kind of investor who wants the story Wall Street doesn't put in the headlines, do me one quick favor and smash that like button. And subscribe so you never miss a breakdown like this. It genuinely helps more than you know. All right, let's get into it. To understand why the smart money is suddenly circling, we have to look at the two forces currently tearing this stock apart. On one side of the ring, you have capital dilution. AMC has been under heavy fire lately after raising $350 million through share offerings. For a lot of people, that's where the story ends. More shares means less value per share. Simple as that. But on the other side of the ring, there's something almost nobody is talking about. A fundamental recovery that is actually outperforming the company's own post-pandemic records. We're talking about strategic balance sheet surgery that didn't just pay a few bills. It effectively pushed the company's most dangerous debt obligations all the way out to 2029. So the real question becomes, is this the slow death everyone assumes, or is this a complete technical reversal hiding in plain sight? But before you get too bullish, we need to talk about the bleeding that's been happening on the daily chart. If you've been watching the price action, it's been a painful few weeks. After a massive surge toward nearly $3 in late June, the stock entered what I call a controlled bleed, bottoming out at a swing low of $1.60 on July 8th. And here's what most people miss. This wasn't a random sell-off. It was pure dilution fatigue. Traders were reacting to the mechanical pressure of those equity raises, and that pressure effectively masked every single piece of good news the company released. It genuinely felt like the floor was falling out. So if the price was collapsing, why would anyone in their right mind be buying? That's exactly where this gets interesting, because here's the number that makes the dying company narrative almost impossible to defend. In the most recent quarter, 115 institutional investors added to their AMC positions, while only 82 decreased. And we're not talking about tiny hedge funds nobody's heard of. UBS Group AG increased their position by a staggering 465%. Barclays jumped in with a 383% increase. Even Susquehanna more than doubled their stake. Now think about that for a second. When firms with this much data crunching power and this many analysts start loading the boat during a price collapse, what exactly do they see that the rest of the market is completely missing? Because these people don't buy on emotion, they buy on math. And it wasn't just the big banks showing confidence. It was the man at the very top. CEO Aron has been a controversial figure for years. Love him or hate him, you can't ignore what he just did. In the last 6 months, he personally purchased 250,000 shares on the open market. And this matters more than most people realize. In the world of finance, there are a million reasons an insider might sell a stock. Taxes, diversification, a new house, whatever. But there is usually only one reason an insider buys with his own cash. He believes the stock is undervalued. This sends a loud, unmistakable signal to both Wall Street and Main Street that leadership is personally lashed to the mast of this turnaround. But here's the thing. Confidence from the top only matters if the actual business is working. So is it? Well, right now, the theaters are absolutely packed. The core business is currently operating at peak efficiency. AMC just logged its busiest U.S. weekend of 2026. And what drove it? A massive $160 million domestic opening for Toy Story 5. Let that sink in. This single data point blows up the entire theaters are dead narrative, because people will still show up in droves for the right content. But honestly, the ticket sales aren't even the most interesting part of the story. The real magic happens once those people actually walk through the doors. Because AMC has quietly figured out how to make significantly more money from every single person who walks in. They are mastering the art of the high margin upsell. AMC just recorded its strongest weekend for food and beverage revenue in over a By pushing premium formats like IMAX and Dolby, and by expanding their menus, management is squeezing more profit out of each guest than ever before. It's no longer just about how many butts are in seats. It's about yield. It's about maximizing the financial impact of every single blockbuster. But what if the company isn't even planning to stay a movie theater at all? What if they're about to redefine what a cinema even is? Because that's exactly what's happening next.
AMC is launching something called Arena One.
And this is where the long-term growth story gets genuinely exciting. They're turning 300 theaters into live, interactive concert venues. And here's the brilliance of it. The whole thing runs on a revenue sharing. It requires almost zero upfront capital from AMC. Think about what that means. They are taking underutilized screen time, dead hours where those seats would sit empty, and transforming them into multi-purpose event spaces that generate cash. This is a massive step away from being purely dependent on Hollywood's release schedule. But you might be thinking, none of this matters if the company is about to drown in debt. So let's talk about the move that changed everything. This is the surgical strike that most people completely misunderstood. AMC used the proceeds from a $200 million to redeem $125 million of senior notes due 2027. Now, to a casual observer, this looks like they just printed more shares out of desperation. But to a debt analyst, they just did something brilliant. They traded equity for time and for cash flow. This single move is expected to save the company roughly $7.7 million annual interest expenses. That's cash that now stays on the bottom line instead of vanishing into interest payments. But the interest savings aren't even the biggest win here. The real game changer is what this did to the company's timeline. Because by clearing those 2027 notes, AMC effectively pushed its major debt wall all the way out to 2029. And in the world of turnarounds, this is time is the single most valuable currency a struggling company. This maturity extension gives the operational recovery. Projects like Arena One, 3 more years to fully mature without the threat of a principal repayment crisis hanging over their heads. They have successfully played for time. And in a market like this, playing for time can be the difference between a total wipeout and a genuine multi-bagger recovery. So the question is, has Wall Street noticed yet? Because they're finally starting to adjust their math. Analysts are starting to blink.
Macquarie recently lifted their target to citing a much better EBITDA forecast for 2026.
B. Riley is even more maintaining a buy rating with $2.25. And from where we sit right now, that represents a 17.6% upside. The consensus is quietly shifting. The bankruptcy risk that everyone was so terrified of is fading, and the fundamental value is starting to peek through all the noise. But if you really want your jaw to drop, look at how AMC is valued compared to its own competitors, because that disconnect is genuinely shocking. Here's where it gets almost hard to believe. Look at the price to sales ratio. The average entertainment industry stock trades at about 1.2 times sales. AMC, it's trading at 0.3 times sales. That is a massive discount. Essentially, the market is pricing AMC as if its revenue is worth 75% less than its competitors' revenue. So ask yourself this: what happens if AMC simply re-rates to a normal industry valuation? Not a premium, not a moonshot, just normal. If that happens, the upside potential isn't 17%. It could be multiples of that. So we've got the fundamentals lined up. But what about the actual trade for next week? Technically, we are sitting at a crucial junction right now. We've established a very solid floor between $1.50 and $1.60, and which lines up perfectly with the 100-day moving average and those recent swing lows. Think of that as your line in the sand. Above us, there's a major psychological resistance sitting right at $2. And here's the setup. If AMC can break and hold above that $2 mark, the technical dam breaks, and we very likely see a fast, aggressive move straight toward those analyst targets. But there's one specific catalyst in the options market that could make that move happen faster than anyone expects. And this is the part you really need to watch. Keep a very close eye on the July 17th expiry. There's a massive call wall building right now. We're talking nearly 100,000 open contracts at the $2 and another 82,000. Here's why that matters. If the price sustains a move over $2, market makers will be forced to hedge by buying shares. And that buying can trigger what's called a gamma squeeze. Now combine that with a 9.5% short interest, and you've got a situation where any positive momentum next week could turn into a vertical spike. So could an AMC squeeze actually be incoming? The ingredients are quietly lining up. Let's put the entire plan together. Here's the full breakdown. The final verdict is that AMC is a speculative buy for anyone looking for a turnaround play and a hold for the more conservative investor. For a short-term swing trade, I'm looking for an entry between $1.88 and $1.92, targeting $2.20 with a strict stop loss at $1.65. If you're playing the long game, anything under $1.90 accumulation zone, targeting $2.50 and the big payoff that comes on August 10th during the earnings call. If AMC can show that Toy Story 5 and Arena 1 are narrowing their losses, we're not just looking at a trade. We're potentially looking at the end of the entire downtrend. The key level to watch is that $2 breakout. Once that door swings open, the move toward $2.25 could happen. Now, before we wrap up, I've got to be crystal clear with you. Everything in this video is for educational and entertainment purposes only. I am not a financial advisor, and none of this is financial advice. The stock market carries real risk, and you can lose money. Please do your own research and never invest more than you can afford to lose. Your money, your decision, your responsibility. With all that said, I want to hear from you. If AMC breaks and holds that $2 level next week, how high do you honestly think it goes before the year is over? Drop your price target in the comments below. If this breakdown gave you a fresh perspective on AMC, do me a favor and hit that like button. Leave your thoughts in the comments and subscribe with notifications turned on so you're first in line for the next deep dive. The next few weeks could be pivotal for this stock, and you do not want to be watching from the sidelines. I'll see you in the next one.